Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with Ross Marinell. Ross, 2022 is in full effect. Man, it's been a ride.
Wow. We're off to the start. Well, it started, right? I guess that's a fact. What a interesting time to be a market participant in seeing this transition from 2021 to 2022. But hey, listen, it's good to be here. I'm excited we are podcasting again. And we have a lot of interesting topics to dive into today.
100%.
And to kick it off, before we started recording, you were checking out today's job numbers and some of the revisions.
So one of the things that's been, everyone's watching right now like a hawk is anything that they can try from an economic standpoint to get some sense of what the Fed is going to do. Now, one of the things that I have really appreciated about Powell and the Fed that he's, as he's been under the leader of the Fed, I guess, or the chair, he's tried really hard to communicate and kind of be transparent about what's going on. But this was interesting. So jobs report came out today. Payrolls gained 467,000 jobs in January, despite, all the stuff we've heard in the news about the Omicron surge. And so I'm reading from this article, just kind of skimming through in CNBC, but this is what jumped out at me. So the number for January, 467,000, that was higher than what they expected. However, it says that the expectation or the Dow Jones estimate was 150,000. So big time gain over what the expectation was. But down a little further, it says, this is what was interesting. December had initially reported a gain of 199,000 jobs. Well, that number was revised up to 510K. November was 249K. That number was revised up to 647,000.
Ooh.
So for 2 months, those 2 months, the initial counts that we were given have been revised upwards by over 700,000. And then we had this beat today. So, I mean, it may not feel like jobs are coming back, but the data is telling a different story. What are you thinking?
Well, this is great news. And if you have been listening to our podcast for a little while, one of the things we talked about at our recap of 2021 was just the changing job environment and the job landscape. We had a lot of people retire maybe a year or two earlier than they may have otherwise expected to. That took and opened up a couple of million extra jobs, 2 to 3 million extra jobs.
Sure.
And our labor participation rate has been down, and it has been down. It's still below the pre-COVID labor participation rate numbers, but that gap is closing. That's really important. If we can get back to the pre-COVID labor participation rate numbers. Now, look, we have over 10 million open jobs. So there is a lot of work out there that needs to be filled still.
Right.
But this is the best possible news I think we could have come from this jobs report, which it was a surprise. We were actually expecting, ADP was kind of expecting it may actually decline this week. There may be job losses.
They thought it might be negative.
Right. So not only did we get a big number today, we got big revisions going back the last couple of months. That's
and to your point about the participation rate, in that same article, it says that that rate, actually the labor force participation rate, popped up 0.3 percentage points and now is back to its highest level since March 2020. It's within 1.2 points of where it was before the pandemic. So
that's right.
Obviously we've created other problems for ourselves that don't just include the jobs market, but it looks like the jobs market has been coming back and there still remains, significant openings for people who may want to re-enter the labor force and look for work. There's opportunities out there. So that's a positive.
It's fantastic again, and it's great to see. Hopefully, we can continue to close that labor participation gap. Some of it can be explained from the early retirements. We know that, but still, we're seeing people upgrade their work life. They're upgrading their income. They're finding maybe a better career path. Great, move around all you want. There's all this jostling between jobs has been happening for the last several months. But if people can ultimately get themselves to a better place where they can make a more comfortable living, a higher income living, this is wonderful. So yes, will it push labor prices up? Maybe. I don't care. I'm just thrilled people are getting back to work.
Well, I mean, obviously the counterbalance to that is, well, what's going to happen with inflation? Because, as more and more people go back to work, and if the job market gets tight and there's, competition for workers, workers tend to have to be paid a little bit more money from a recruiting standpoint. And people can be concerned about that, how that's going to impact markets with inflation. And so what are we seeing right now as far as the current environment with inflation, and what are your thoughts about what we're going to see in the next couple weeks?
So as we have talked internally over the last couple of months, this has been a big conversation.
Right.
We probably, as good as the news was for the jobs today and the revisions over the last couple of months, I think is as bad as the inflation number is going to be next month, which, we'll see this come out here in the next few days. I think we're going to see a startling inflation number.
Right.
The challenge is I combed through a few different categories just to see what was happening in inflation. So if I went back and looked through changes in the consumer price index for food. So 2019 through 2022, right? We always talk about inflation. Who does inflation hit?
Right.
Well, it hits our lower income, our middle income. If you're a family of, let's say, 4, and you're looking at where does your dollar go? It goes
Right.
9 different directions already. We know this, right? We live it.
100%.
So it goes to childcare, it goes to healthcare costs, it goes to food and gas, and then you want to go on vacation and you want to have a life and you want to enjoy things. And so that money goes everywhere. And so when we see the essentials like food and energy costs go up, that eats into those other areas where people want to consume and spend for their enjoyment versus just sustainability.
Mm-hmm.
So here we have changes in consumer price index 2019 through 2022. This was looking at year over year. So from December of 2020 to December of 2021, meat prices, so meats, poultry, fish, up 12.6%. If you look at like beef was up 18%.
Right.
In a year. That's December of 2020 to December of 2021.
That's crazy.
Eggs, 11% increase.
Which a lot of people don't understand, especially when you mention something about eggs, is how many other food products have have eggs or egg derivatives as part of them.
Right. So, and then you wonder, well, gosh, that's not good. What's some of the things that are leading to that? So then I've been reading articles about the increase in fertilizer prices. It's the top issue for farmers right now. And so in the United States, we grow a lot of corn and wheat and things that need fertilizer. It's their big fertilizer consumption products, right? And so all the crop production ingredients are higher. So this was, just looking back over the last year. So, whatever it is, if it's ammonia, if it's some of these other ingredients that they need to build the fertilizers and make them, it's just the prices are through the roof. So the ingredients that they're putting into the fertilizer, all of those are up. Of course, there's supply chain issues there too.
Yeah.
Because they've got to transport the product. They've got to get it to the destination. That's higher. Some of these ingredients like the ammonia, well, it requires a conversion process, right? That requires natural gas. So you think about, now you see the cost of natural gas going up. And so the ingredients in the process they have to go through to make those fertilizer products, it just goes through the roof. And then we slap on some tariffs for products that are coming in from overseas, and it just ends up being a catastrophe. And so we're trying to work our way out of it. Of course, they had slowdowns in production during the COVID lockdown as well.
Sure.
They got behind. Now they're finding a labor shortage. Prices are going up. They're trying to get ahead of it, but those types of things push prices right into the food market, which hits everybody in the pocket. It's no fun to go to the grocery store anymore.
Oh, 100%. Well, I mean, I imagine, there's so many things that happen if, obviously like restaurants, which typically run on pretty thin margins anyway, but if they have to start raising menu prices and food prices, it gets more expensive to eat out. So then more people go to the grocery store, which, grocery stores, one of the things that I think we learned, I've heard some just personal anecdotes from different people that we learned, is that the way that we had kind of run our inventories and our restocking, I mean, we were, kind of a just in time, like the minute if we needed something, we would order it. But when the supply chain kind of has problems and breaks down, it gets harder to restock items. But if, people, start cutting back and they don't eat out as much because, food prices have gone up, and restaurants have been forced to either, reduce staff because of all we went through with staffing and service, being able to have people there, or food prices have gone up. So they had to raise their costs. And so it's more expensive to eat out. So more people go to the grocery store, buying stuff at the grocery store. Grocery stores run out quicker, can't get it resupplied. There's all kinds of stuff, and it's like a domino effect. And I think one of the things that, for anyone who's not, a microeconomist that doesn't understand all these different things, just think about something like gas. How do we get food from point A to point B, right? It has to be, shipped or trucked or whatever, how, or to move the freight, right? There's a cost of energy. And if energy prices rise, and they sustain that increase, it's going to permeate throughout the market. And so inflation is one of those things where we're going to see it. And that's one of the ideas that you mentioned that I think we're going to see too. I agree. We've read some stuff where we're in wintertime too. So a lot of people are using energy to heat their homes. The next inflation number could be large. And so I think it's not so much that the number is big, it's what people worry about that's going to create for the Fed. Is the Fed going to say, man, we need to be more aggressive, or we're not, and that's going to be where everyone's going to try to figure out what happens next, I think.
Well, that's the other component of their mandate, right? They want full employment, and they want a controlled 2% inflation target. Well, we're going to be so far beyond that. We're not even going to be in the same stratosphere. So so I'm looking at crude oil prices back up today, just looking at the number right now in real time, over $92 a barrel.
Oh yeah.
I made a joke on Twitter a couple years ago. It was like the price of a barrel of crude oil is about the same as a 12-pack of Sycamore Brewing beer. With, of course, Sycamore, one of our local microbrews here in the Charlotte area. It's kind of wild to see that price swing from literally the lowest prices I'd seen in probably 20 or 30 years or longer to almost back to $100 a barrel.
We were talking about that yesterday. Remember, I believe in 2020, oil futures actually went negative. And so if you were to pull up that chart, and we'll throw up the chart on the site, but if you look at that chart, I mean, from that point, it's been just kind of a steep angle upwards. And now we're at prices that we haven't seen in quite some time. And with all these other things we got going on, it's just not a great environment. And the thing that just feels really wrong is that it feels a lot of the stuff, especially with energy, is self-inflicted.
So check this out. I was looking at this. There was a report from a site called the American Oil and Gas Reporter, and they calculate the number of rigs. This data is provided by Baker Hughes.
Oh, my cousins.
Yeah, there you go. So in end of December 2018, we had 1,083 rigs pumping oil and gas.
Yeah.
2019, it goes down to 805. By the end of 2020, so production had really come to a halt.
Right.
It was 351.
Oh, wow.
And we're back now at the end of 2021 to 586. But you're talking half of where we were producing 4 years ago. So yes, and I know that some of our listeners are probably encouraged by that because they want to see a more advanced transition over to renewable energies, and I understand. And my view is we still need this, and we still need it, whether we like it or not. It's essential to maintaining prices, and if we're not comfortable with it, then I think we're going to see some inflation continue for a while.
Well, I don't think anyone, I haven't met anybody, doesn't matter where they are on the political spectrum. I haven't met anybody that isn't open to trying to have or being more inclusive as far as, this transition to green or renewable energy sources and things that are cleaner for the environment. It's just, do you slam on the brakes and create a 25 car pileup behind you to try to get on that exit? Or do you gradually like merge over and over time, incentivize companies with tax credits or, different ways to, motivate, this development? I just feel like we've gone about it all wrong with, this abrupt, we're going to yank the steering wheel and try to like careen off the highway.
Right.
And it's causing us at the worst possible time.
I think we don't need the self-inflicted wounds of forcing prices higher because we're just shutting it down. I think you're right. People are open and willing to make those transitions and do things that are better for the environment. Case in point, let's just look at Tesla. I mean, so Elon Musk, we laughed last pod, he was man of the year, probably very deservedly so. It's a cult following at Tesla. They love him. People love them, and they'll buy the car, whether it's the best electric vehicle out there on the market or not, because of his reputation. And so people are willing to do that. If we let market forces kind of do it on their own, we will gravitate there. We really will. But this is, the inflation that's happening. A lot of it is it's starting to spin out of control. We've got to bring it back in.
100%. All right. So obviously we started out the year, kind of on a sour note with the market. A lot of things within the stock market, the different indices has been interesting to watch and unfold. Some discomfort and quite frankly, some pain for some companies. It's been wild to see the gyrations on a day-to-day basis. So, lead us off here. What are your initial thoughts on what we started out so far with?
As you talked a little bit about Fed Chairman Powell, they have sort of laid out the roadmap for this year, and they are stopping bond buying program. So that takes a little bit of the quote unquote punch bowl away.
Right.
But they're also telegraphing 3 interest rate hikes to the federal funds rate. So what happens? Well,
not 25, not 25 interest rate hikes this year.
Isn't it funny to see all the wild speculation around it when he's, there's, whether you like the process of how the Fed discusses and shares this information. I mean, they do stand in front of Congress and tell you what they expect. So,
right.
I mean, I guess we'll have to take them at their word for it. I don't know that there's a lot of reason to speculate and make guesses about it, but
as gotta have an opinion out there.
But as interest rates rise, that does change the investor's perspective on where does capital outflow to then.
Right.
So over the very, very favorable federal market period, we've seen capital flow to high growth companies with low to no earnings. And we've sort of made jokes on the podcast over the past that, cash flow is coming. It may be a few years down the road. Well, the challenge when interest rates are rising is that we discount those cash flows. And so with the higher rates, you really have a higher preference for cash flows now. And you want to see companies with earnings today, because if you're going to pay a little bit more in interest rates for that, there's more value to have those earnings today versus a year from now or 2 years from now or 3 years from now. And some of the movement that we've seen inside the stock indexes, just on an individual stock basis, I've got a few here. I want to rattle them off just to kind of let people know some of the movement that's happened on individual stocks.
Right.
So I tried to stick with some of the most popular companies that fit this category. So I looked at Shopify. So Shopify, very well known business. We've many people probably use it, may not even know about it. At one point, their 52-week high on their share price was 1,762, trading today around 809. That's about a 54% decline in the stock price from their high to their current valuation.
Say that
today.
again. What decline?
54% decline.
Right.
We talked a little bit about some of the IPO, SPAC conundrums that we had last year, which were really
conundrum is a nice way of putting it, but yeah,
massive faceplant is better, probably more accurate. But Coinbase was a very popular IPO. It was it's a highly used exchange, so it has market penetration. But the stock price fell from a high of $429 to $181 a share, so that's a 57% decline.
Right.
If you look at one of the most popular funds and most discussed funds last year was ARK, ARKK. That's Kathy Wood's fund. Peaked at $159 a share, now trading at $69 a share. So that's a 56% decline. She invested in a lot of these businesses that I'm mentioning as well. So I'll do I'll do one more. Okay. So this is ticker NET, NET. This is Cloudflare. Very popular cloud computing company. It peaked at $221 a share, now down to $96 a share. So that's a 56% decline. But listen to this. At their peak, their price to sales ratio topped out at 113 times. So the value of their business, 113 times their sales.
Just
not
some
their
optimism.
earnings.
Just a little optimism baked in.
If you had a business that made $1 a year and you went to go sell it to somebody, not $1 profit, $1 of sales.
Right.
And you went to say, I would like to sell my business to you. Somebody goes, okay, well, you didn't make any profit, but you had $1 in sales. How much would you like to sell it to me for? And you said $113. They would just
for you.
laugh.
I make a special price.
Right?
$113.
We have $1,000 of sales. I would like to sell it to you for $113,000.
Oh, yeah,
what do you think? No. How will I get my money back? How do I get my money back? Right? We get our money back through earnings, through cash flow. If we don't have it and it's not on the horizon at some point. So my point being, some of this was just the pendulum swings too far in both directions. It swings too far on the downside. A lot of times it swings too far on the upside.
Well, remember, I mean, like anything else, and I use this word very cautiously, but manias are interesting because remember, a lot of this stuff happening, the Feds, they slash interest rates, they're buying up, providing massive liquidity to the bond market. Then you've got the stimulus money coming. There was so much money created and pumped into the system, and a lot of it found its way. Again, this has kind of been my take on this. A lot of the money that came out, not all of it, but a lot of it found its way to actual consumers this time. Because unlike the financial crisis, they gave it to the banks, and the banks kind of they shored up their balance sheets and they kind of controlled the flow of the money into the markets. That's not what happened this time. This time they had PPP loans, they had emergency, economic injury disaster loans at like 0%. The PPP loans were forgivable. They gave stimulus checks out. There were a lot of people that, who did not lose their jobs, that were still working or still receiving a paycheck. They got stimulus checks for not just themselves, but for their kids. And, we're all trapped at home. And so what became the fun game for everybody to play? It was the stock market. And so you started to see like these, the GameStop bubble. You started to see Wall Street bets become a thing. Reddit became a thing, and everybody had a little bit of coin to play with. And so they were getting in there. And then, you had the SPACs and the IPOs, and, a lot of these companies were bid up on, pure speculation, because what else are we going to do?
Well, and my point to kind of bring that up is it's often that we see pretty serious movements in stock prices underneath the surface of the index. But if you look at some of the broad index movements this month, even as rocky as it's been and as dire as it's felt a few of these days over the last few weeks, you're looking at the S&P 500 down around 6% year to date. The Dow down 3.38 year to date. The NASDAQ has taken the brunt of this because it's more technology
Tech
driven.
companies.
It's down 11.29%
Mhm.
year to date. And small caps, Russell 2000 index down 6.67. So
Right.
even though we have some pretty dire movements and pretty harsh movements in certain stocks, if you look at the broad indexes, yeah, they've drifted down some. It's been unpleasant, but it's the diversification does work. We're starting this year, just year to date, the divergence between the S&P 500 value component versus the growth component. The growth component of the S&P 500, I look at ticker SPYG, it's down a little over 10%, but the value component is down 1.26. So the diversification does matter. If you look at even just international stocks and some of the emerging markets, those indexes, for the most part, are down less than what we're seeing here locally in the United States. So when we build asset allocations and we use exchange traded funds to capture an exposure to an index like the S&P 500, some of this underlying movement is always there and constant, but it doesn't necessarily have that same effect on the big index.
Well, that's why, I had an interesting conversation with someone about a week ago, and we were talking about specifically a stock, and the stock that they brought up was the stock Rivian. And, Rivian was, they're in business with Amazon, and they're going to create electric vehicles. And, they've got a beautiful demo vehicle. They don't have a single vehicle that they've delivered out, I don't believe. And, so a lot of hype, but man, they attracted money like gangbusters. And of course it's down significantly. And, they were just talking about their experience in like buying that stock and it being down. And I said, look, see, it's harder than it looks. And the concern that I've shared with you and with a few other people is as markets go back and I would say normalize, which, define that at your own peril, but when markets are constantly just going up because there's accommodative Fed, there's easy money policy, money's pouring in, and the rising tide just lifts all boats. Now that accommodation is going to be, we've been put on notice. Hey, we're going to start tightening. Rates are going to go up. We're reducing our bond buying. Now it's going to be who is actually making money, who is profitable, who actually has a good business, sustainable business model for in the future. And, that's been part of what has been going on with the markets. And yes, it can weigh on the indexes. But, we've seen Amazon had great report. Microsoft had a great report. Apple had a great report. So good, solid businesses are still finding ways to, despite people who might be skeptical, they're still finding ways to have, post solid numbers. So that's a positive. But one of the things that I worried about, and this is what I was saying, I was sharing with people, is there were a lot of people that finally got off of zero and started investing in 2020, in 2021. And they're all excited about stocks because stocks are sexy again. And they think that, oh, stocks just go up. You remember Dave Portnoy's on Twitter telling everyone like stocks only go up, and he did his whole shtick. And I'm worried that a lot of people think, oh, this is like super easy and all you got to do is put money in there. And I'm like, it's not as easy as everyone is trying to say it is. It's difficult because there's so many factors that you have to contend with. And I worry that people are going to get burned because they are the people out there that have, that are up, 100% on some, speculative position that probably just got smoked in the last 3 weeks.
So I think that's a good summary. We are heading into a different period where it's less accommodative. We are going to see interest rates rise this year. We will see inflation continue to be a problem. We need to thread the needle on these issues carefully, and it will require a lot of work. And I don't wish bad returns on anybody. And I want to see our businesses grow and increase earnings. So we're always rooting for U.S. businesses.
Yeah, absolutely. We don't want to, I don't think anyone wants to see the market crash. I mean, except people that are maybe short the market and, I don't have,
Just
I don't
depends how much
have,
time you spend on social media, I guess.
I don't have great things to say about people who short the market. I think that's why do we bet against companies?
All
That's
right.
silly.
So we just talked a little bit, Michael, about some of the challenges facing the
Yeah.
market over the next several months. So what are some things that retirees can do to help prepare and plan for some of these more volatile moments?
Well, it's, I mean, a large portion of the people that we work with are, planning and preparing, for their retirement years. Some of, are on the cusp of retirement. Some have just retired. And then we've got some folks that we've been working with now for a while, and it's great. But the number one thing that we always go to is we think that you've got to have a plan. You need to have some thoughtful conversations about, learn about who you are as an investor. There's more than one way to skin a cat, and, have a written, thought out, thoughtful retirement income plan where you're going to go through this idea of like, well, what happens if we do see volatility? Because one of the things that we've shared in many, many meetings with people, workshops, is with technology and with trading being done by computers and algorithms, I just think the speed at which we're going to see market corrections is going to be somewhat breathtaking for a lot of people. And we need to be ready for that. I mean, that's normal. The same type of stuff that we've experienced historically is going to continue to happen. But how are you positioned for that?
Right. I think one of the tactics that we use is we do segment investments based on their objective. And so, for example, you may have with a 401k plan that has your entire, the balance of your net worth in it, that's kind of doing everything. One of the things we like to do is sort of break that down a little bit to say, okay, we need a certain portion of that to distribute income over the next 5 years. Let's segment that out and let's change the risk profile on that.
Mm-hmm.
And maybe we have a portion that's going to be balanced growth. And so we know it's going to be highly diversified, but still a good exposure to stocks. So we know how that and can prepare people for how that might move during good and bad market environments. And then maybe we have a segment that we just want pure equity exposure to say, hey, we want to go and get growth over a long term, but be prepared because this account's going to be your most volatile. This may move more during good and bad market environments. So when you kind of look at those statements, you can see, okay, here's the investment segment that I have, distributing income for the next 5 years. It's going to move in a tighter channel. And then as we kind of move out that risk profile, we know they're going to move a little differently. I think that helps people just understand, all right, where's the short-term risk to cash flow? Is that account okay? Then to kind of move down the ladder. How's the balanced growth model doing? Well, it's highly diversified. There's multiple positions in there covering, equities versus fixed income to alternative assets. And I think that helps just compartmentalize where the risk is.
Right.
And the time horizon that's associated with that. So the equity model, we may not be in a plan, be looking to access those funds for a decade. So we have time to let that go through the market movements that are going to naturally occur.
Yeah, I mean, and you got to think too, we naturally do mental accounting, every day. I mean, we with our budgets, with, just what we spend at the grocery store, as we talked about earlier, versus what we spend on fun and entertainment. We naturally do some of these things, and that's the goal, is to try to keep things, aligned with not only what we're used to doing, but with your values. And so, I mean, it's okay if you want to be more conservative with your funds, but we have to understand, inflation is going to take a toll over time, on your purchasing power. So that has to be factored in. But one thing too that I always encourage people to think about is what kind of heavy lifting are you expecting your portfolio to do? Because, if you've got other sources of income and you've got Social Security and you've got several things going on where you don't need as much from your portfolio, or you don't need money immediately from your portfolio, you can think about the investment world and market volatility a little bit differently than someone who's going to immediately start having to pull money from their portfolio the day that they leave from retirement, because their regular paychecks are going to stop. And so that's why we say, like, there is no one way to do this. Everybody has to think it through for themselves. Like, we know from our own experience that, coworkers talk with coworkers, and, people go online and they get Google and they look at all the financial articles that are written about, here's how to do retirement the best way. But I'm telling you, you need to sit down with somebody who understands multiple different ways to create retirement income plans and find the one that's going to work best for yourself, because you're the one that's going to have to live that plan. Nobody else, no article that you've read, the author or no coworker or neighbor, they're not going to have to live your income plan. That's going to be you. So that's the biggest thing that I would tell, people right now is that, we're entering into a time where the Fed is at least telling us that they're going to be removing accommodation. They will try to begin raising rates. The market's going through a re-rating cycle, and you need to be just prepared that there could be some volatility ahead. That's not a bad thing. Nobody gets mad about volatility to the upside. It's just the downside that everyone gets worried about. So we want people to be ready for that.
Awesome. Well, that's a good way to cap it. I do think everyone's unique in their feeling toward good and bad news in the market. Our objective is to try and get to know our clients well enough to know how we need to work with them, because we all have our own internal biases and feelings toward it. And so it's just natural, and they're hard to break. And so what we try and do is get to know that and how you want us to communicate with you during those good and bad times, so that we can keep on plan.
Yeah, 100%. Well, for those of you who came and stuck with us this long, we thank you for listening. Ross and I, we'd love to get on here and just share our thoughts and what's going on. We want to keep you informed. Thank you for listening to the show. If you got anything you would like us to talk about on the show, any topics, feel free to email us at themoneyhuddle@bcplanning.com. And as always, thank you for listening, and we will talk to you next time.